TDAQ, revolutionizing high-income ETFs, maximizing growth and income with zero DTE covered calls. How are they doing it? Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, and today we're going to dive deeper into a fund that a lot of people talk about, and that is Tap Alpha's TDAQ. And TDAQ, what's it doing? How's it generating income? And should you have this in your retirement portfolio? Well, we're going to cover it all and answer it all today for you. And we want to just throw a shout out to all of our YouTube subscribers and all of our Patreon supporters. Thank you so much for being part of this channel. We appreciate it as we continue to grow through the journey of life. Let's get into today's video. Tap Alpha TDAQ, the Innovation 100 Growth and Daily Income ETF. Now I'm going to start off with and say Innovation 100, fancy way of saying the NASDAQ 100, so they don't have to pay the extra fees. And we're also going to talk about that daily income. No, you're not getting paid daily now. This is a monthly payer, but what they're doing is their strategy is basically changing on a daily basis. It's going to maximize the growth and the income with zero DTE cover calls. So the evolution of income investing from traditional beta to the next gen alpha strategies. Traditional ETFs were passive index tracking of the S&P 500, the NASDAQ 100, doing really what they, just tracking that right along the base. They generated income, doing different things with that. Standard covered calls came into play, which boosted the monthly income up to 10 to 11% in yield. Then the next gen come in, and the next gen was for growth and income, which were using zero DTE strategies to maximize the yield and add growth to the account. Now, Tap Alpha wasn't the first one to use the zero DTE strategy, but they're using it in a unique and different way than most companies are doing, and it's becoming successful. The new core, the covered call ETFs that evolved from the niche products to the core portfolio holdings for income-focused investors. The strategy selling covered calls against held assets to generate consistent premium income and reducing volatility, these are the goals and the strategies that they're trying to play. And then the shift, moving beyond income only to strategies that capture significant market upside while delivering those higher yields. That's what Tap Alpha has done in this next gen, trying to get growth added back into something that's been generating good income. So introducing TDAQ. This is Tap Alpha's Innovation 100. Their annual yield right now is looking at about 17% plus. Their assets under management, $150 million already. Now this fund came out September of 2025. So this is a fund that's not even been out a full year yet. And you can already see it's generated a lot of interest with increasing its assets under management and the yield that they've been able to develop. They have an expense ratio of 0.68%. And personally, I think that's fairly fair, below what most of the other companies are charging. And when we do look up against the benchmarks, and this is the thing you always got to start with, is TDAQ. They are working off that Innovation 100. Well, that would put us up against the QQQ brand. Now remember, Tap Alpha with the TDAQ is looking for yield, for income, and they're also looking for growth. While QQQQ is really designed for growth, same thing with SP 500 programs like SPYI, they're all looking for growth, not just basic income. So when we take a look at the dividend yields, of course, TDAQ is going to knock it out of the park at 17.2% versus 0.6 for QQQ and 1.3 for the S&P 500. Now distributions, they're paying out monthly while the other two pay out quarterly. Now over the past 6 months is the big thing. They've given a 14.5% growth over the past 6 months compared to 12 and 9.5. So they're actually outdoing the underlying. Now the NAV sense, the stability, all three of them are extremely high when you're doing the comparisons. Now, of course, we don't always chase yield on this channel. We're also talking about total return, and we're also looking at price return. So navigating the NAV decay in high yield ETFs is a tricky business. The total return. This is the true measure of the wealth generation. It combines capital appreciation, which is your stock price growth, plus reinvesting the dividends. So this is a line that you'll want to see trending always moving up. The price return is the tracks the movement of the fund's net asset value, which is what better known as NAV, excluding the dividends. In many high yield funds, this line crashes as capital erodes to pay its yields. This is where you get NAV erosion. So TDAQ gives you the positive of both ends. You can see that since September 25th, we have had a steady growth of total return. And then we've had, the NAV has pretty much followed very similar to that line. Of course, we don't have as big a growth, but it definitely has the price in holding its NAV across the board. Unlike peer funds yielding 30 and 40% that suffer that critical NAV decay, eating themselves alive, TDAQ's NAV has remained steady, and the zero DT strategy aims to preserve the principal while generating income. So they're actually doing a very good job across the board. Now the secret sauce, this is what when I started studying this and doing the research, this is what got me excited. And I got to be upfront and tell you, I do own TDAQ. I have invested this. I did wait, until we saw some hardcore, basically about 3 months into it. So I'm fairly new to it. But what really had me going is this secret sauce, as I call it, the zero DTE covered call. Now, the daily expiration equals daily income. This is where it was unique. The zero DTE 0 day to expiration. At 9:30, it sells calls. The market opens up, the fund writes call options on the NASDAQ 100 that expire the same exact day. So basically, we set it at 9:30 and we sit and wait for people to buy accordingly. They harvest rapid decay. The option loses value faster in the final hours. So that zero DTE captures this decay at the absolute peak rate. At 4 p.m., the cash settles out. The options expire, the profits are locked in for the day, and resets the entire thing for the next trading day. Okay, that's how they work it. So basically, we're looking at 6.5 hour cycle to generate income through the process. Now, the structural advantage, holding the underlying while owning the actual stock matters for total return. Other zero DTE funds, they have no physical shares. They use long-term options for their exposure. The cash drag, significant cash held to collateral that yields less than stocks, and the gap risk often misses the overnight price jumps due to that synthetic nature. TDAQ is a different operation. It owns all 100 stocks. So it holds the physical QQQ components directly. The fund's dividends. It collects actual stock dividends to boost its yield. And the overnight capture. This is the exciting part. It fully participates in pre-market and after-market moves. Now, you talk to anyone on the stock market, they'll tell you those are big market bouncers. Okay, so the upside is capped from selling the options only during the market hours of 9:30 to 4 o'clock. Overnight gaps are fully captured. So you go back to covered call options are capped because you're saying, I will sell at this price. If it goes above it, they're not getting the higher price. But they take those all away when the stock market closes. So after hours, all the way up to 8 p.m., they're capturing any growth in their stocks, along with the previous days from 4 p.m. So the overnight and pre-hours can generate some increased growth of TDAQ. So the fund is working 24/7 for you. Now the downsides and the risk of this protection. Now let me just explain to you this one. This is where caution needs to be done. While yields are high, the strategy is not without structural limitations. Understanding the mechanics are before allocating capital, you have to understand the risks and the rewards. The V-shaped recovery risk, okay? Because of this fund sets its price at the beginning of the day. So any intraday caps can be dangerous. If the market tanks at the open and rockets back up by noon, the fund doesn't get the stop out of that rally. It doesn't change in the rally because they set the price at the beginning. An example, if this fund was active in the April 2025 tariff news that we got on April 2nd, it caused a 2% drop that followed by a 2% rally. Well, TDAQ would have captured the drop, but it wasn't capturing the rebound. Okay, so you understand they're setting it at 9:30 in the morning. And if they have the drop off come down and then a recovery all of the same day, they're missing out on the recovery because they set it so early in the day. Now, the lower volatility dampening, this is your downside, a little more of your downside protection. The daily option collecting small premiums, and really what they're collecting is 0.1% in a day. This offers almost zero cushion against a 3% market crash compared to monthly covered calls. So TDAQ is not a defensive fund. It is an income enhanced growth fund with full downside exposure. So I'm really coming to you telling you there is no downside protection of this. Okay? It's going to take a lot for it to recover in a market crash. Now, taking a look deeper underneath the hood, you can see that this fund, like I said earlier, 0.68% expense ratio, but it has 4.9 million shares outstanding already. Add in $150 million of net assets. Now, remember, this thing's not a year old, so since September, it's had a 7.57% dividend yield with a $1.86 payout. So right on track to hit that 17% yield that they're expecting out of it. It is a monthly payer. Now, you show it right here. We're in some rocky times. We're in a pattern right now in the investing that we don't know where the market's going to go. We start heading in one direction, and then we have the military actions and oil pricing going up. So we don't know where the market's heading. Businesses don't know, and they hate that part of it at the most. So you can see we've had some choppy roads. But the thing that happens, this fund always has its recovery. So realistically, is now a nice time to be possibly purchasing? Well, we're so close to the 52-week low that I have to market and saying it could be a good opportunity for us to grab some gains. The other thing that we find is the performance. Since inception, since September 4th of 2025, this thing has had a total return of 12.59%. So again, that's not a full year. Then the other thing we break it down is in the past 2.5, well, I'm going to say realistically 2 months because you have January, February, and then now we're about halfway through March. 2.98% year-to-date loss and only 0.30% in 1 month. Now, am I excited about a loss? Never. I never enjoy losses. But what you have to look at, the way the market's been and the way the environment's been going, I think right now we're in the terrible times. We're still maintaining and holding its own for total return, better than most. Now, the other big thing that I bring to the table, and this is not a sales pitch for TDAQ. I just think this is some information that a lot of people look at and question, is this a good fund to be a part of? The distribution history is definitely relatively short, but there are some things that stand out so far. The main standout with TDAQ has been it's able to keep distributions with consistent range since its inception. Okay, it's keeping the income going. The growth, yeah, we're struggling with the growth a little bit, but we are keeping income. So it's doing what a lot of other funds are doing. And definitely inside of this choppy markets that we're talking about. When we take a look at the distributions, we're looking at averaging right now still at 17.75%. It's that double-digit yield that they're still putting out there. Now, another big benefit of TDAQ, which is why we talk about this, especially in retirement type accounts. If you're using this in a 401k or an IRA, everything's perfectly fine. If you're using this in a brokerage account, this is where it becomes really critical, because the benefit at TDAQ has that potential tax efficiency of its payouts over time. Basically, in Section 19A, the notice indicates that 100% of the distributions were classified as return of capital. So this is a fund that's been using the return of capital more as a tax haven versus a true art that they can't pay their bills. So this is great that it's basically taking your basis and kicking, I call it the tax can, down the road. So they're showing that they're basically coming into about 100% return of capital on those distributions. So they've taken care of the tax burden. They've taken care of the distributions coming out. And you can see from the previous screens that there's no NAV decay because they're able to make the dividends that they're paying. So the system is working. The growth will come as the markets straighten out across the board. Now, that is not a guarantee. All this stuff can change in a matter of seconds, okay? Because I am not I can't tell you the future. I'm not a financial advisor. I'm giving you what's the information that's in front of me on the screens that I read across the board. Now, the conclusion, the final take of this. Now, does TDAQ earn a spot in your portfolio? Well, it's going to be simple here. In bull markets, the strong uptrend environment, like we've seen between 23 and 24, would be an outperformer. In sideways markets and the volatility, it's an income machine. So I like it in bulls and sideways markets. But in bear markets, man, this is where I got to put a caution out there. It has the downward trend and it can crash scenario. So to me, TDAQ is an impressive high-income engine for the current market conditions. It solves the NAV decay problem of older funds, but requires active management during crashes. So I always call this a core satellite position. Is this something I would have in my retirement fund? Most definitely. I have no fear of that. Is this a category where you're going to put into your growth, or is it a foundation, or is this your high yield income? And I have to go to that high yield income side of it is where I'd put this fund. As much as I like the operations and everything that they do to it, we always got to be concerned if we run into a bear market, it's not good to be a part of this in a bear market. But 2 out of 3, as Meatloaf always said, 2 out of 3 ain't bad. Let me know your comments below. Love to hear what you guys think of TDAQ, how it's done since September, and give me your input. Do you own it? Do you not own it? Leave a comment down below. And most importantly, hit that like button. That's what helps the channel the most. And if you're not part of our Patreon group, don't be afraid to join over there. It's free. Get in there, get some additional information behind the scenes.